So another amazing day of trading here in the live trade room. Before we get started talking about all the trades we took today, everybody, I want to remind you guys here, there is risk out there in these markets, unfortunately. So please take a moment, guys and gals, and please read that risk disclaimer. All right, speak to somebody you trust regarding your risk capital. And remember, half the battle of being a new trader is having the right trading plan. What does that mean? Well, I've seen many trading plans in my era. I've been doing this over 10 years now, almost 12 years now. And since I became an educator, I've been experiencing all kinds of different trading plans and different trading ideas. And one thing stands out. You got to make sure as a new trader that you're given a plan that will fit a new trader's existence. In other words, if I gave you a trade plan that required you to use discretion, if you needed to make a decision based on experience and you were a brand new trader, that would be an unrealistic trading plan for you. Okay, discretionary, decision-making skills are something that you're going to get with experience. In my opinion, right? In my opinion, the best trading plan for a brand new trader is one that gives you absolutely nothing to think about or discuss. It is all specific. Do this now, don't do that. Do this when you see this. Don't do that when you see this. Here's where you enter. Here's how you enter. Here's exactly what to do. Here's exactly what not to do. It's just like going to the grocery store, buying a recipe for a birthday cake. If I didn't have a recipe for that birthday cake, how would I know what to do first, what to do last, since I've never baked the cake before? If I have a recipe, I can easily bake that birthday cake without having any experience. So remember, specifics are what I'm looking for. Now today was an incredible day. Again, a little bit slow because it is summertime, and again today we talked about the fact that it's going to be wedged right between yesterday's FOMC. Today was the ECB's version of the FOMC. Tomorrow's non-farm payrolls. And on top of that, we were speculating that we thought there might be more traders than normal on vacation this week because only about 15 days from now, kids go back to school. So we thought this today might be a little bit challenging, but we also knew, though, with nat gas inventories and jobless claims and the ECB press conference this morning, we knew there was probably going to be some pretty good action. We got started this morning with one of the biggest trades we've seen all week. And here was how the trade set up. And what I love about this trade was a simple fact that the risk-reward ratio was an incredible thing. Now, you may not see this very often in this live trade room where we are scaling into a trade. All right, we try to keep it as simple as possible, so I'm not going to be discussing all kinds of different strategies, but this particular strategy today worked out incredibly well. And at the top of this wedge, we had come in this morning and we had determined that we had a price wedge on crude. And at the same time, we also noticed that jobless claims came out lower, and the jobless claims pushed the price on crude oil above the highs from yesterday, up to the high of the wedge. The best part about this was we had some big clues now. First of all, crude oil futures is a market that says fade the news. Crude oil is a fade the breakouts, fade the news type of market. In other words, if news comes out at 8:30 and crude jumps up, there's a high chance that crude's going to fail and come right back down. So with that said, that was the first big clue. We knew that crude was a fade the news, a fake out breakout market. And if you have questions about that, let me know. I'll be happy to go over it. And Bruce, I see your question right now. I'll be right with you here. Be right with you. So first clue was the market personality. The second clue is the structure, the price structure. The technical price structure is called a wedge, or maybe a triangle. The wedge pattern tells us specifically exactly what to do. What does a wedge tell me to do? Buy the lows, profit target at the highs, sell the highs, profit target at the lows, right? Pretty basic. Use the price wedge, use the triangle to our advantage. First clue was market personality, second clue was price structure. And then it got really easy. Let me zoom in here now, and I'll show you exactly how we enter this trade and how we properly manage it. Now, once again, remember, I'm at the top of this range, so I already know I'm trying to sell. I already know the news pushed the price up, and I'm looking to fade that news. So we already had a bunch of really good clues this morning to get us started looking for the short. Then the bottom drops out. The wave pattern long fails. This is something we train on every day in our trainings. We get short, and the way that we're going to use this is I'm going to get short with one contract when I have the most amount of risk. See, this is another thing that's a key to a new trader. If I got short with 4 contracts right now, how much risk would I have? It would be 4 contracts times the size of my stop. In other words, if I jump into the trade all in and then scale out of the trade, taking profit as I go lower, that means that if I make a mistake on this position and get stopped out, I'm going to have a pretty bad stop. I'm going to lose a bunch of money. I'm going to lose my full stop loss times 4 contracts. So my goal is when I get into a trade, I want to have, well, I'm going to probably have the widest stop when I get into a trade, right? Every trade I get into is going to have a little bit of risk involved. And if I have to take risk on a trade, wouldn't it be wise for me to do it when I have the least amount, right, to risk at that time? So if I'm going to take a 45 tick stop, which you can see referenced up top there, a 45 tick stop is going to mean a big loss if you're trading 4 contracts. But if you're trading 1 contract, I can stomach that. See how much easier it is? And with the most amount of risk when I first get into the first right position, I want to have the least amount of risk. So I get short by 1 contract. I'm in at 15 short. Then the trade keeps going in my direction, and I'm going to keep adding to my position. I add 1 more at 05s. I add 1 more at 65s. I add 1 more right at 05s, and I am off to the races. At the end of this whole progression, once again, remember, we already know where our final target is. How do I know where that target is? Because that's what the price structure told me. Sell the highs, put that final target all the way at the lows. And of course, we gave everyone a chance to be ready for that because we announced this so far ahead of time. Everyone in this room this morning knew that 87.60 was where I was taking profit on this trade. So we know where our profit target is going to be. We scale into the position. First entry is the failure. Wave short, wave short, wave short, wave short. I'm going to be entering short at 15s. There's 1 contract on. At the 05s, another contract. Now when I trade short, 1 contract each, 15 and then 05, that brings my average price down. I'm then going to trail my stop to 25. Once I pick up 65, my average entry is 88.95. Now look at this closely, right? Look at this closely. I began with a 45 tick stop. What does my stop look like now? I'm now an average entry at 95. It's much closer. Now it's a 30 tick stop. See where I'm going with this? The most amount of risk, I want the smallest size of my position. The least amount of risk, I want the largest size of my position. And then one more key component. If my target is at the lows, wouldn't I want the most amount of capital on that trade when I'm making the most amount of money? See how this is completely different than the scaling out strategy that we use? And see how this really fits well for a new trader? Let me keep going. And I'm really going to show you why it fits well for a new trader. Once we finish adding the final contract here at 05, again, that means 4 contracts now total were used. I need about $2,000 per contract in my account, by the way. And there's no reason why you couldn't just do this with one contract and let it drop. Do that for a day or two, then you've tripled your account size. Now you can trade 2 contracts, 3 contracts, 4. So you'll be trading with house money very soon. Start with 1 contract, easy. By the time I get down to 88.05, I now have an average entry of 88.73. How do I get that? Take the 05, the 65, the 05, and the 15, add them up, and divide by 4. That will give you your total average entry. Now I have a proper stop loss, and my stop loss will be 2 swings up, stop loss at 78. My stop began at 45 ticks. My stop then went to 30 ticks. Now look at what my stop is now. Remember, the objective was I want to have the least amount of risk when I have the most to lose. I now have 4 contracts on, and my stop is a measly 5 ticks. Now this means there's no way I can lose money on this. This means now I've got full contract sizes in. It's clear what this market is doing. I can see it's going lower. I'm in this thing to win this thing. I did it without a wide stop and a big excessive amount of risk. We take our final target. It's waiting there for us. All 4 contracts are taken out. 60 is the final target. Average entry was 73. Unfortunately, I can't use the 15 initial entry. I wish. The average entry is 73. 73 is the average. 60 is the target. That's 113 ticks of profit. Now, obviously, making over $1,000 on one trade is always a good idea. But think about what this does for a new trader. Remember we talked about a new trader needs the right plan? Well, this plan means that I could get in with very little amounts of risk. I can get out with a ton of profit. What's that? Risk-reward ratio. What is the risk-reward ratio on this? Well, I risked 45. So 45 goes into 113. What's that? Right about 2.5 times. We'll say 2.25. I don't have my calculator out right now. So 45 times 2 is 90, right? Plus another 45 is 35. So yeah, we'll say 2.5. Whatever it ends up being, that means that for every 2.5 losses, I get a winner. That means I can make 2.5 mistakes and only 1 correct decision, I make that money right back. Now compare that to a lot of other trading methods out there that will put you all in with the most amount of risk, and then by the time you get the final target, you have the least amount of contracts on the trade. So the risk-reward ratio is backwards for a lot of other trading strategies that I think are not best suitable for a brand new trader. In my humble opinion, if I would have started my career as a trader with the ability to make 2 mistakes for every 1 successful decision, I'd be retired right now. I would have never blown my accounts out because, again, I can make mistakes without getting completely wiped out. And that's the key, is that if you know that you're not going to get wiped out by a loss, that gives you the confidence, no more fear in your trading, you're in the trade, you've got the plan in front of you, and you're in it to win it. Just a fantastic example today of how we technically prepared for this trade. Fundamentals were nice to move the price up. The technical entry, the trade management all came together. It was amazing. A great way to start, just a fantastic day in this live trade room.